WorldCom Inc. completed its corporate headquarters campus in Clinton, Mississippi in 2001 at a cost of approximately $500 million, a sprawling complex of buildings on more than 100 acres that had been designed to house the corporate operations of what had become, through an aggressive acquisition campaign across the late 1990s, the second largest long-distance telecommunications company in the United States. The campus was completed as the company was imploding. WorldCom filed for bankruptcy on July 21, 2002, listing liabilities of approximately $41 billion, the largest bankruptcy filing in American history at the time, surpassing the Enron bankruptcy that had itself set the record only months earlier. The bankruptcy was not produced by competitive failure or market contraction or the telecommunications sector's broader decline, though the sector had declined sharply from its late 1990s peak. It was produced by an accounting fraud of approximately $11 billion, the largest accounting fraud in American corporate history at the time of its discovery, in which WorldCom's financial controllers, under the direction of its chief financial officer, Scott Sullivan, and with the acquiescence of its chief executive officer, Bernard Ebbers, had capitalized approximately $11 billion in operating expenses as capital expenditures, artificially inflating the company's reported earnings across multiple reporting periods. The Clinton, Mississippi headquarters campus, completed at approximately $500 million, stood as the physical monument to an institutional confidence that was itself partially manufactured through financial fraud. A company whose reported earnings had been falsified was building a corporate campus whose scale and cost expressed the institutional permanence of an earnings trajectory that did not actually exist. The forensic entry point for this case is the relationship between a corporate headquarters' physical ambition and the financial reality that the headquarters was designed to express, because the WorldCom campus documents the specific proposition that a headquarters building can be a monument to institutional fraud, as precisely as it can be a monument to institutional achievement, and that the physical structure remains after the fraud is discovered and prosecuted, expressing in concrete and steel a confidence that the criminal proceedings eventually documented as false. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. WorldCom's acquisition strategy across the late 1990s had been built on a specific financial logic, whose validity depended entirely on the continued accuracy of the earnings trajectory that the acquisition campaign was using as its primary currency. WorldCom used its stock as the primary consideration in its acquisition transactions, paying for MCI Communications, CompuServe, and dozens of smaller telecommunications companies with shares whose market value reflected the earnings trajectory that WorldCom's financial statements were reporting. The earnings trajectory that WorldCom's financial statements reported between 1999 and 2002 was substantially false. The capitalization of operating expenses as capital expenditures allowed WorldCom to report profit margins that its actual operations were not generating, inflating both the reported earnings per share that drove the stock price and the stock price whose market capitalization was the primary acquisition currency that the acquisition strategy required. The covenant that WorldCom's board of directors, its auditors at Arthur Andersen, and the securities analysts who covered the company did not read carefully enough was the one embedded in the relationship between the reported earnings trajectory and the actual operational performance of a telecommunications network company operating in a sector whose capital expenditure requirements, revenue trajectory, and competitive dynamics had been transformed by the sector's late 1990s overinvestment and the subsequent demand normalization. WorldCom's actual telecommunications operations were generating operating performance substantially below what the reported financial statements indicated, a divergence that would have been apparent to any analysis that compared the company's reported cash flows from operations before the capitalization adjustments to the capital expenditure levels that a company genuinely generating the reported earnings would have required. The fraud was not sophisticated. It was large. The $11 billion in capitalized operating expenses was not hidden in complex financial instruments or offshore structures. It was a straightforward misclassification of ordinary operating expenses as capital expenditures, a manipulation whose detection required only the application of standard cash flow analysis to the company's reported financial statements. That analysis was not applied with adequate rigor by the auditors, the board, or the analyst community, before the fraud scale made the company's actual cash flows incompatible with continued operation at the scale its reported earnings had implied. At what point does an institutional audit process's failure to apply standard cash flow analysis to a company's reported financial statements constitute a fundamental failure of the accountability framework the audit process is designed to provide? Leave your analysis in the comments below. The appraisal of the Clinton, Mississippi headquarters campus's value at the time of the WorldCom bankruptcy in 2002 reflected the specific challenge that a purpose-built corporate headquarters campus presents in a distress sale context, a complex of buildings designed specifically for a single company's operational requirements, whose fair market value to any alternative buyer is substantially lower than the construction cost the original developer invested. The $500 million construction cost of the Clinton campus reflected WorldCom's specific operational requirements and institutional ambitions, a headquarters campus designed to house the corporate operations of a major telecommunications company with the specific technical infrastructure, the telecommunications equipment, and the operational configuration that WorldCom's specific business required. The market value of that campus to an alternative buyer who did not share WorldCom's specific operational requirements was substantially lower, reflecting the general principle documented in Case File 030's examination of the Pontiac Silverdome. Purpose-built facilities designed to serve a specific institutional tenant's specific requirements have residual market values that approach the underlying land value when the specific tenant departs, because the specific configuration that made the facility valuable to the original occupant reduces its attractiveness to alternative users who require different configurations. The bankruptcy court administering the WorldCom estate was therefore managing an asset whose relationship between construction cost and market value was particularly adverse, a $500 million investment whose recovery value to creditors in a liquidation scenario was a small fraction of its construction cost, because the campus's design had been optimized for a specific institutional use case that the bankruptcy had eliminated. The eventual disposition of the Clinton campus, which involved significant efforts to attract alternative corporate and government users to the facility, produced recovery values that reflected the campus's specific characteristics as purpose-built corporate infrastructure in a Mississippi market, with limited demand for headquarters-scale corporate campuses. The appraisal of the WorldCom campus's value is therefore not merely a real estate valuation exercise. It is a measurement of the gap between the institutional confidence that the campus's construction expressed and the actual economic value that the campus represented to the world that existed after that institutional confidence was revealed as partially fraudulent. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The institutional denial embedded in the WorldCom fraud is the most precisely documented instance of deliberate institutional fraud in this channel's archive, structurally distinct from the conventional denial patterns this channel has documented, because WorldCom's management knew the reported earnings were false at the moment they were reported. Deliberate misrepresentation rather than the self-deception that the corporate governance failures in this channel's other case files produce. The specific forensic significance is in what the fraud left behind physically. The Clinton, Mississippi headquarters campus, completed as the fraud approached its discovery, is a physical monument to institutional confidence that was manufactured rather than earned. The campus's $500 million construction cost expressed the financial trajectory of a company whose reported earnings were false at the moment the construction was being approved. The building does not know it was built with fraudulently reported earnings as its financial justification. It stands in Clinton as it was designed to stand, a corporate headquarters campus expressing the institutional permanence of a company that was simultaneously falsifying the financial statements that made that permanence appear credible. Bernard Ebbers, received a 25-year prison sentence following conviction. Scott Sullivan received a 5-year sentence in exchange for cooperation. Arthur Andersen collapsed as an independent entity through market response following its WorldCom and Enron audit failures. The campus remained. The company it was built to express did not. The campus stands in Clinton as the physical record of what WorldCom claimed to be and what WorldCom actually was simultaneously, and provides no information about which description is accurate to any observer without access to the criminal proceedings public record. That inability to distinguish genuine from manufactured institutional confidence in the physical form of a corporate headquarters is the specific forensic condition this case file contributes to this channel's archive. A headquarters building expresses what its developers intend to express, not what the underlying financial reality actually is, and the criminal proceedings required to document the gap between intended expression and actual reality are the only reliable mechanism for correcting a physical monument's false institutional testimony. The campus stands as a physical argument for the proposition that institutional confidence, expressed in concrete, steel, and a $500 million construction budget, is indistinguishable from manufactured institutional confidence unless the financial records underlying that confidence are independently and rigorously verified. The WorldCom fraud's specific contribution to the forensic record is the demonstration that the verification mechanism, independent audit, had itself failed at the precise moment. The campus's construction was expressing the confidence that the audit was supposed to verify. The MCI Center Communications campus that the WorldCom bankruptcy estate eventually converted the Clinton facility into, through a series of disposition and redevelopment efforts managed by the bankruptcy estate and subsequent purchasers, represents the specific resolution trajectory that purpose-built corporate campus assets in distressed locations tend to follow. Alternative users, governmental agencies, educational institutions, and technology companies attracted by below-replacement cost acquisition prices, and by the specific infrastructure characteristics that the original design had created, eventually absorb at least portions of the campus at recovery values that reflect the distressed sale context, rather than the original institutional ambition. What the WorldCom campus case reveals in the context of this channel's 72-case archive is a failure category that every previous case file has documented in its financial dimensions, but that this specific case documents most precisely in its physical dimensions, the specific mechanism by which a corporate headquarters building becomes a monument to fraud. Every corporate headquarters in this channel's archive was built to express some form of institutional confidence. The Sears Tower expressed Sears' confidence in its retail permanence. Trump Tower expressed confidence in the Trump brand's commercial authority. The AT&T building expressed confidence in a telecommunications monopoly's institutional permanence. The WorldCom campus expressed confidence in an earnings trajectory that did not exist. All of those institutional confidences were in some sense projections rather than established facts. Sears' retail permanence was undermined by competitive dynamics the company had not adequately anticipated. The Trump brand's authority was more contextual than universal. The AT&T monopoly was legislatively dismantled before the building was completed. But none of those institutional confidences was deliberately manufactured through falsification. WorldCom's was. The campus is the only building in this channel's archive that was constructed to express institutional confidence that the company building it knew, at the moment of construction, to be false. If this case file changed how you evaluate the relationship between corporate headquarters construction and the financial reality that headquarters buildings are designed to express, subscribe, because the next case examines a campus whose collapse was produced by competitive failure rather than fraud, but whose physical legacy presents the same forensic questions. And in the comments, given WorldCom's documented $11 billion accounting fraud and the $500 million headquarters campus completed as the fraud approached discovery, what specific audit standard modification would most effectively have detected the expense capitalization scheme before it reached the scale that the campus's completion expressed? The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.